Hello everyone, welcome to the class of Financial Institutions and Market, Econ 242. I'm Yasser Saeed and today we are going to study the stock market. Two things that we are going to learn today in this lecture. First thing is we are going to define the stock market and discuss a bit about it, the functionality of the stock market, the purpose of the stock market. And then we are going to discuss some of the instruments that are traded in the stock market. And these are two types of instrument. One we call the capital stocks and the other we call the preferred stock. Now our today's lecture that is going to focus on the first one, the common stock. Then in the next lecture we are going to cover the preferred stock, and after that we are also going to discuss the presence of uh, primary market for the stock that we trade. So let us start with the definition of the stock market. Uh, but before we try to understand what stock market is, we need to understand the capital market first. A capital market is a market that trade debt, that includes bonds and mortgages, and equity that we also call stock instruments with a maturity of more than 1 year. And basically, we differentiate capital market from the money market, which sells instruments with maturity of less than 1 year. Then in the previous lecture, we focused on the bonds market, and bonds market we discussed the types of bond market, the various instruments that were traded in that type of market, and we studied the maturity that was related to bonds market that was usually from 1 year up to 10 years, and it can go up to 30 years. But today we are going to talk about the stock market, and stock market is different from the bond market. And with the first major difference is that the instruments traded in the in the stock market that have no maturity. Its maturity, we may say, is infinite, and it continues to the point at which investor wants to hold these instruments. So the stock market is basically differentiated by the level of maturity, but there are certain other characteristics that also defines the stock market. Definition of stock market is very simple. Um, Stock market is a market where stocks are traded. It cannot be more simpler than that. Stock market allows supplier of fund to efficiently and cheaply get equity funds to public corporations. In exchange, the fund users give the fund supplier ownership rights in the firm as well as cash flows in the form of dividends. Therefore, the corporate stock or equity serves as a source of financing for firms, in addition to the debt financing or the retained earnings or the surplus profits that sometimes firms use for the financing. In the 1990s, the market value of corporate stock outstanding increased faster than any type of the financial security. Uh, Legally, holders of corporation common stock or equity have the ownership stake in the issuing firm that reflects the percentage of the corporation stocks they hold. Specifically, corporate stockholders have the right to share in issuing firm's profit, as in the form of dividend payments after the payments of interest to bondholders and taxes. They also have a residual claim on the firm's assets if the company fails or is dissolved after all debt and the tax liabilities are paid. Furthermore, the common stockholders have voting privileges. They can vote for the board of directors. So, let us discuss the instruments that are used in the stock market. Two basic types of the stocks that are traded in the stock market. One is the common stock and the other one is preferred stock. Then there is a third one, which is a combination of these two. Hybrid stocks are very rare, but they are somehow the combination of the common stocks and the preferred stocks. So let us discuss these in detail here. Common stock is fundamental ownership claim in a public or private corporation. There are many characteristics of common stock that differentiate it from other type of financial securities. So let us talk about these differentiating characteristics of the common stocks. The first characteristic is that of discretionary dividend payment. While common stocks can potentially receive unlimited dividend payments if the firm is highly profitable, they have no special or guaranteed dividend rights. Rather, the payment and size of dividends are determined by the board of directors of these firms. Thus, common stocks have no legal recourse if dividends are not received, even if the company is highly profitable and chooses to use these profits to reinvest in new projects for the purpose of the firm's growth. Another drawback with common stock dividend is from the investor viewpoint is that they are taxed twice. There is double taxation. One is at the firm level, at which we call the corporate tax, and corporate tax are usually between 20 to 40%. I believe that in Pakistan the current corporate tax is 35%, and it can go up to 40% as well. It can be decided by the government, but usually the point is that the corporate tax rate is usually too high. Then after that taxation, there is another level of taxation that is called the personal level or personal income tax. Investors can partially avoid the double taxation effect by holding stocks in growth firms that reinvest most of their earnings to finance growth rather than large dividends. Generally, earnings growth lead to stock price increase. The stockholders can sell their stocks for a profit and pay capital gains and taxes rather than the ordinary income tax or dividend income. Under the current tax law, the capital gains tax rates are lower than the ordinary income tax rates. For example, in the 2000 ordinary income tax range between 15 to 39% of an individual taxable income. Okay, let us talk about the calculation of the dividend payment, not only the dividend payment, but the overall return on these firms. Now, the return we have labeled it as discretionary dividend payment, but the overall return from holding a stock is in two forms. One is the dividend payment, and the other is the appreciation or the capital gain over time. What is capital gain? Basically, it is the increase in the price of the stock. When you buy a stock at a certain level, for example, 10 rupees, its price increases to 12 rupees. So you are gaining 2 rupees per share. So apart from the capital gain, the other income is the dividend payment that we have discussed in detail. The total return is the summation of the dividend payment over time and the capital gain over time. So here we see two portions of the return. If I want to highlight it, this first portion, this identifies the capital gain, whereas the second portion, this identifies the dividend, the gain from the dividend, and the total return is the summation of both of these incomes. Then we come to another characteristic of the stocks, that is the claim on the residual claim status. Common stockholders have the lowest priority or claim on the corporation's asset in the event of bankruptcy. they have a residual claim only after all senior claims are paid, that is payments to the creditors or payments to the bondholders. When all of these payments are paid, and then the owners of common stockholders, they are paid at last. For example, the bankruptcy of Washington Mutual Bank in 2008 left its shareholder with nothing, because all of the money that came from the investment in those stocks, they were distributed among the credit holders and all those people. Then another problem with not a problem but a characteristic of the stock common stock is its limited liability. So number third, that is our limited liability. One of the most important characteristics, we may call it, and that is an investor is legally limited to its own funds. Legally limited liability implies that common stockholders' losses are limited to the amount of their original investment in the firm. If the company's assets value, wealth held outside their ownership, claims in the firms are unaffected by bankruptcy of the corporation. Even if the losses of the firm exceeds its total common stock ownership, claims in contrast to sole proprietorship or partnership, stock interests mean that stockholders may be liable for the firm's debt out of their total private wealth. And that's how it becomes different from the proprietorship. Then finally, this firm has a fundamental has voting right. Sorry, the investor in the common stock has a voting right as well. It is a fundamental privilege assigned to common stock, and while common stockholders do not exercise control over the firm's daily activity, they do not manage it. They can hire the managers, they can vote for the managers. They do exercise control over the firm's activity indirectly through the election of board of directors. Uh, for example, there was in the mid 2000, Walt Disney Corporation, the famous corporation that makes cartoons. The shareholders were unhappy with many actions of the firm, and as a result, especially they were not happy with the performance of the CEO. So what they did was that changed they changed the chairmanship through the election, through the voting rights. The shareholders shifted the firm into, let's say, two different corporations through voting rights. So this is basically the type of voting rights, but we may have some firms with dual class voting rights. So what is dual class voting rights? Let us shed some light on that as well. Now, as I have said, that there are corporations with dual class stocks. Dual class stocks means that two classes of common stocks are outstanding with different voting rights within the same corporation. For example, I have taken here a screenshot from the annual report of PTCL for the time period of 2016 to 2017. And if you look at the equity section of the firm, where they discuss the common stocks, we have two types of common stocks. One they call Class A shares, and the outstanding Class A shares can be seen in the figures, as well as you look at the Class B shares, which are less than the Class A shares. But these two type of shares have different voting rights. Class A shares have one vote, whereas the Class B share voting rights equals to 4. So why does this happens? In the specific case of PTCL, and this was a national corporation controlled entirely by the government, but since it was underperforming, the government decided to privatize PTCL, and Etisalat, a company from UAE, invested in this corporation. But the government also does not want its communication system in the hand of entirely in the hand of foreigners. So what it did was kept some of the shares with itself in the form of the voting rights. They changed the voting rights for it, and the purpose is to keep an eye on the functions of the firm if it does not go against the overall stakes of a specific country. So they created two types of shares. With one, you in this scenario, even the number of shares are less in the class B, but their voting rights may be higher than that in the class A. So basically, they get less revenue, but they have more control over the firm. So this is how dual class firms work. Now, here is another term that is most commonly used in the selection of the board of directors, that is the proxy vote. Now, basically, when voting happens, usually the common stockholders are invited to attend an annual meeting. In that meeting, and the firm, the investors select uh, select their representative for the board of directors. But there are then most of the stockholders that cannot attend the meeting, usually because of uh, they are busy somewhere in their jobs, or maybe they are living in different countries. So when that happens, then we need to have a proxy vote. Then most of shareholders that do not attend the annual meetings, most corporations anticipate this and routinely mail proxies to their stockholders prior to their annual meeting. A completed proxy returned to the issuing firm allows stockholders to vote by absentee balloting or by authorizing, and the alternate way is to authorize a representative of the stockholder to vote on their behalf. So through that letter, either you send your vote for someone, or you can authorize someone to vote in your behalf. It is estimated that on average less than 40% of the total possible votes are cast at corporate meetings. However, use of the internet may have increased this number in the future. By the late 2000s, most of the US firms such as the Alcoa, Federated Investors, and Hershey were putting proxy statements online and allowing votes to be cast via the internet. Now, the entire documentation delivery process can be electronically automated with the use of services such as EQServe or automatic data processing proxy vote. So the official documentation is delivered in the electronic form to the shareholder who log into the system with a control number or a personal identification number, and then vote for or against the resolution presented, or against or vote for or against the certain board of directors that are to be elected. So in the 2000, the average firm offering online voting received almost 10% of its votes electronically. Now this technology has advanced more. Further data needed to be studied regarding the online voting, but I believe that this might have risen to up to let's say 90%. So this is all about the common stock. We have covered the common stock in today's lecture. In the next lecture, we are going to study the preferred stock and the hybrid security. So hope you have understood the lecture. If you do have any question, please feel free to ask on in the comments or in the uh, through WhatsApp number. You may have that, so you can ask about it. Thank you very much. See you in the next class.